Now, here we're going to look at the consumer a bit more, and we want to look at a different leading indicator, and this is the Sales Managers Index. So this is coming from the worldeconomics.com, and it's just another way to look at some of the data. And you're seeing some softening here, but the key piece is you're still growing. You're just seeing things soften a bit, but it's looking at it from a slightly different perspective. Instead of the producer, product manager, you're looking at the sales managers index. So here's where you're seeing some of that slow down. So sales manager index has come down, still in the growth prospect. As we've seen previously, business confidence has come lower. That has been reflected in University of Michigan consumer confidence. Market growth index has actually turned a bit negative, and that's again being shown in consumer confidence and these other pieces. So it's just feeding back to because that you're getting closer to the consumer. So the consumer is essentially starting to balk. And the sales managers are seeing that before the product manager, because the product manager has a lot of things that they're looking at. There's inventories, there's different pieces. So you can get a slightly deviated view. And I think most of this shows that things kind of flatline a bit, both on the good and the bad side. And you see this progression. And the question is going to be, when does that turn negative? And unfortunately, that comes down to a very fickle entity, which is the U.S. consumer, where we can try as much as we may to try to understand what the consumer is going to do. But the consumer can say one thing and spend a different. And when we look at credit and the use of credit, there's still a lot of leeway that could allow them to maintain some of their spending a bit higher than what our initial expectations would be. So then when we look at some of the underlying sales growth index, as you can see, is fairly flat. Prices charged remaining high. Staffing levels have gotten a bit better, but profit margins are coming down because prices charged index has flatlined, sales growth has flatlined, and staffing levels have bounced. And this comes back to some of these pricing levels coming a bit softer, the consumer coming in a bit softer, which again is going to lead to where are we going to see some of the shakeout in terms of new sales. So then when you look at where the Conference Board U.S. leading index is, though minor compared to when pandemic struck, January's leading economic index from the Conference Board had its first decline since April 2020. So again, it leading to a bit more of this concern as we go into not only just February, but March. But then you're getting some of those benefits, which again is going to keep us a bit muted. But the question is going to be, how is the consumer being impacted by this? Because the companies might feel one way and the consumer continues to be under pressure. And that's when you can have consumers' income expectations are not improving per their confidence has deteriorated since mid-2021. So the fear is your income is not going to go up, which again is going to weigh on how much you're willing to consume if there's a view that your income is going to be impacted, especially in 6 months out, as you see prices going up what seems like week on week, as you continue to see not your wages unable to keep pace as your living wages continue to rise. Then when you look at consumer confidence, dropped to 110.5 versus the 110 estimate, which is down obviously from 111.1. Present situation component up slightly to 145.1 versus 144.5 prior, which was revised down from 148. Expectations down to 87.5 versus 88.8 prior, which was revised down from 90.8. So again, things are not moving in a positive light, but you can see they're still higher than they were. So this just leads to that slowdown. You're just starting to see that slowdown creep in, and depending on the metrics you use, Michigan or consumer confidence, you're starting to get some of these adjustments, which all lead to a sluggish consumer going into what is normally a more active period of spending in the spring and summer, which we think is going to weigh on what some of these expectations are for activity. Which then when you look at manufacturing from the Richmond Fed, you can see that it moved down in February to 1 versus the estimate of 10. Shipments, new orders, backlogs, capacity utilization, and inventories of both raw and finished goods now all in negative territory, but employment upticked and is expanding. So you're getting some mixes, which, and if you look, it's not negative, it's still positive, but you're not at 10, you're at 1. You're not at the previous in January, which was 8. You're down, and that's where I think that mixture of when you look at new orders. For some areas, it's improving. Other areas getting a bit softer, and that's going to mute some of what these expectations are. But again, it all nets out to growth with some of the leading indicators getting better. CapEx expectations getting better. That's a positive. Expected new orders increasing. Both of these are very leading. They're more leading indicators than some of the others. So even though the number came in well below estimates, there's a bit of an improvement, and it's going to be on CapEx that's being spent, which is going to be a benefit to GDP. New orders is confirming the fact that they're going to have to hire a bit more people. They're starting to see a bit more of this recharge versus what they've seen. Again, these are some of those back and forths that give us a positive view of where the companies are going to sit. Now, on the consumer side, here you can see manufacturing prices paid coming back down, still very elevated. Fed manufacturing expected prices paid came down a bit more. And as we've been saying, we're going to come down to some of these lows that we've seen in 2021 and then see some of that flatlining based on some of these prices that had come down starting to go back up or finding some support here and moving elevated again. Now, when we start looking at how work has changed, when we look at the majority of workers with jobs that can be done from home, they're teleworking even as more workplaces have become available, again, leading to some of the additional slowdowns in the spring versus what expectations are as more people opt to work from home with a flexible schedule versus going into the office, which on the positive side has brought more people out of retirement because it's like, oh, wait, I don't have to commute. Wait, I don't have to come to the city and go to an office? Yeah, I'll pick up 20 hours a week. And that's leading to, again, that problem of full employment when you look at Powell and how is the Fed going to react to full employment and bringing some of this under control. Then when you look at the disconnect between University of Michigan and the conference board, there's a disconnect with University of Michigan, an annual change in leading economic index versus the orange off its peak, but it's still expanding at a strong 8.5%, while sentiment is falling off a cliff. So you can see that at periods there's been broad disconnects. You saw it in 2010 through 2013, and eventually you had them catch back up. There's no reason they have to stop. It just means that you're going to get a bit of a flatlining on both. And again, more of a meet in the middle versus just collapse, but still putting a bit of pressure on how the consumer is going to spend and act as we go forward. And this is looking at the conference board leading index, which is now negative. And this is what we're talking about on some of that pressure. And it's obviously we were slightly negative at the beginning of 2021, and it's also seasonal. So we want to look at how much does this bounce in March and April, and do we start to see a bit more of a return to activity given that we're in a bit warmer period. And retail sales were obviously strong in January. There was a robust spending activity ahead as rising employment and firm wage growth supported household income, but reduced fiscal transfers, elevated inflation, and a spending mix rotation towards services will limit the upside to retail sales growth in 2022. And obviously the comps get harder. And here's where you look at that non-store retails. Again, that retailers, that's that service side that's going to continue to pivot. And as prices continue to go up. Now, a lot of individuals in January and February, they get their bonuses, they get their new salaries for the year. So you could have seen a wage bump, which is, I think, something that's going to be a net positive on the inflation front when you think of wages going up, which will support some of that activity in retail sales. But prices, as we've shown, inflation is outpacing, and that's going to weigh on what those net sales will actually look like. But you do have inventories, U.S. manufacturing trade inventories. When you look, they're at the highest they've been since the beginning, since 2000. And inventory is going to continue to kind of be that stalwart going forward. But when you look at the pressure coming into how a person feels and their ability to spend, this is looking at purchase-only house price index for the United States, and then the average hourly earnings. So when you look at earnings, and you look at prices, yes, wages have started to go up, but look at how insane prices have gone on the home price side. that's going to impact how, again, who's your next incremental buyer. And are wages really going to surge back up, or are we going to see prices come back down? And that's the thing where I think you're going to see prices, again, moving lower and starting to flatline, which we've seen with some of those leading indicators. Now, the Conference Board Consumer Income Differential, again, moving further into the negative territory as people feel uncomfortable with where their income sits versus where prices are. Now, when you look at where their income is, how they're looking at it, then you look at prices, you can see that we're off the highs, but still elevated. And there was a slight tick up for home prices in December. S&P CoreLogic Shiller Index came in at 18.84% year over year versus 18.79 in the prior month. And the 20-city index continues to go up. It was expected to be at 18%, came in at 18.56, as you continue to see a lot of this progress moving up. But there's going to be some shifts in that in terms of what is happening on the volume side, what is the supply, and also how is pricing going to push people out of the market and keep them in the rental space. So S&P CoreLogic gives you kind of the breakdown: Phoenix, Tampa, Miami, Dallas. Obviously, that Sun Belt continues to be the driver as people move out of some of the higher tax regions into lower tax areas, and you're starting to see that continue to drive activity as people move south into better tax situations, and especially if you can work from home, why do you want to deal with the winter? Now, when you look at existing home sales month supply, it's another new record low for monthly supply of existing homes for sale, which is why you're starting to see this disconnect, because we essentially don't have enough wages to keep pace with the increase in price, but there's also not a whole lot of volume. So this is where people are like, look, I'm just going to delay this. I'm just going to kick this off to the side because I just don't have the cash to compete in this market. And there is more that's coming on. So when you look at the increase in price, people are also trying to capture that value. So the cash out refinancing activity surged at the end of 2021 to 40.2% of all loans, which is the highest share since early 2008. As people try to take that equity out before rates went back up, because as the 30-year goes up on the bond side, so does 30-year mortgages. So people are trying to lock in that better rate, take some of that equity out while they can, and just either sit on it or spend it back into their homes. And that's where you're starting to see some of these shifts. But that's also more of a late cycle shift, which is why we remain a bit more on the kind of normalizing factor of how spending will go. Then when you look at MBA purchase index, we're below where we were in 2021, but still elevated. Again, but a lot of that was due to refinancing and people taking equity. Now, existing home sales were much stronger in January, came in at 6.7% versus the expectation of negative 1.3%. So monthly gain was strongest since July 2020. Increase came almost entirely from home prices above 500,000, with the number of homes for sale dropping to a record low of 860,000. But then when you look at authorized housing units that haven't yet been started, rose in January to the highest since July 1974. There is a significant amount of volume coming to market. It's just because of the supply chains, there's been that delay, which has helped keep volumes low, which has supported price. As we get some of these volumes coming on, you'll start to see some of these adjustments down, and that'll help normalize prices a bit more, especially as mortgage rates go up and the Fed stops buying MBS, mortgage-backed securities. So new privately owned homes units started, new privately owned housing units completed. You can see that there's a big bifurcation between the two, and that's, again, due to some of those supply chain issues. And then the new privately owned housing units under construction is moving to a high that hasn't been seen since the 1970s, as the volume looks to come to market. So then when you look at some of the market index, there's still a lot of positivity in the housing market. It's starting to moderate a bit, but you can clearly see it's still high. Traffic of prospective buyers is still increased, is still elevated, it's still at highs. But again, it's starting to come down, especially as wages aren't keeping pace and prices remain elevated. But then when you look at existing homes monthly supply, you get an idea versus historics just how low we are. And that's, again, supportive, which is as more volume becomes available, as we get into some of the key spending periods of spring and summer, that'll help bring and kind of normalize some of that pricing. And then when you look at existing home sales by region, the South continues to be the bright spot, obviously, as people look to move out of that area and into a place a bit warmer with better taxes. And then new privately owned housing units authorized but not started, just to give you an idea of just the amount of new capacity coming on as we look back through 2000. So again, you're getting some of these different shifts and a lot of these different benefits. And these are things that we're going to continue to talk about, because we do think that pricing on homes really starts to come down. Again, we're not saying that you're going to get a 30% move lower, but an adjustment down 5-10%, which is going to be still well above where we were in 2020. But off those highs, as buyers dry up, your incremental buyer and more volume comes on, helping to kind of normalize the situation a bit. Now, after talking about the U.S., we're going to cycle around the world, go to Europe, and then continue on to Asia to talk about where things are happening and what are some of the indicators that we're seeing on the European continent.